Today, we're doing a complete breakdown of Indian Accounting Standard 2. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying Indian Accounting Standard, prepping for a Big Four interview, or working in finance, this is everything you need to know. Before Indian Accounting Standard 2, companies often manipulated profit reporting by undervaluing inventory. Imagine a retailer hiding $10 million in costs, artificially inflating profit margins. Indian Accounting Standard 2 ensures inventory is valued accurately, providing a true picture of profitability. By the end of this section, you'll understand how Indian Accounting Standard 2 maintains transparency in inventory valuation, crucial for investors and stakeholders. Indian Accounting Standard 2 addresses the inconsistent valuation of inventory that plagued financial statements. Before its implementation, companies could choose different costing methods, leading to varied profits and investor confusion. This standard mandates consistent cost formulas, ensuring comparability and reliability. By eliminating arbitrary valuation methods, it provides a clearer financial picture, vital for stakeholders' decisions. Indian Accounting Standard 2 applies to entities with inventories effective from April 1, 2016. A critical requirement is using cost formulas like FIFO or weighted average. Companies must disclose these formulas and inventory carrying amounts in financial statements. Exclusions include construction contract work in progress and financial instruments, making it specific yet comprehensive. Understanding these requirements is crucial for compliance and accurate financial reporting. The cost formula model under Indian Accounting Standard 2 requires businesses to use FIFO or weighted average cost for inventory valuation. FIFO, or first in, first out, assumes older stock is sold first, reducing potential profit manipulation. Weighted average cost averages out inventory cost, smoothing price fluctuations. Mastering these concepts is vital for interviews, reflecting on strategic choices impacting cash flow and profit reporting. Knowing these models provides an edge in understanding a company's financial strategy. Understanding the scope of Indian Accounting Standard 2 is crucial, because errors here lead to costly reporting mistakes. Candidates often forget that financial instruments aren't covered, a classic interview trap. Knowing precisely what's included keeps inventory reporting accurate and compliant. Indian Accounting Standard 2 covers inventory items like finished goods, work in progress, and raw materials, which are essential for accurate cost calculations and financial reporting. For example, monitoring raw materials helps control production costs and impacts profitability. Supplies held for production, though not directly sold, still affect cost structures and require attention. Indian Accounting Standard 2 excludes items like financial instruments and biological assets associated with agriculture, which are covered by other standards. For example, a construction contract is outside its scope as it falls under Indian Accounting Standard 11. Understanding these exclusions prevents misreporting and helps with proper inventory classification. Inventory under Indian Accounting Standard 2 refers to assets held for sale or production. This includes items like a retailer's merchandise or a manufacturer's raw materials. Correctly identifying inventory ensures proper valuation on balance sheets and accurate cost allocations in profit statements, influencing overall financial health. Cost of inventory covers everything needed to bring inventory to its present state. This includes purchase costs, conversion costs in manufacturing, and logistics expenses. For instance, a retailer importing goods factors in shipping and handling into inventory cost, impacting COGS and profitability. Scope edge cases test your understanding of Indian Accounting Standard 2. For instance, land for development falls under IAS 40, not Indian Accounting Standard 2. Spare parts for machinery are included if they're used in production. Knowing these nuances helps in avoiding misclassification and keeps financial statements compliant and accurate. Accurately valuing inventory is critical for businesses like Tech Gear, ensuring their financial statements reflect true economic value. Indian Accounting Standard 2's cost formula model is the backbone, guiding companies through detailed steps to assess inventory costs and maintain transparency. Understanding this model is vital for reporting financial health accurately. The cost formula model provides a systematic approach to inventory valuation, ensuring businesses like TechGear accurately reflect inventory costs. For example, TechGear manages a $5 million inventory of electronics. By following this model, they ensure their financial statements are both transparent and compliant with Indian Accounting Standard 2. This journey involves key steps, from determining cost to recording transactions, each building on the last. For TechGear's $5 million electronics inventory, the first step is to determine total cost, including purchase price, transport, and handling. This ensures accurate valuation. Overlooking costs like freight can lead to undervaluation and misreporting. Indian Accounting Standard mandates that costs include all directly attributable expenses, ensuring transparency. TechGear's initial cost calculation sets the foundation for subsequent classification and valuation steps. TechGear's inventory classification is crucial for accurate reporting. With $5 million in electronics, distinguishing between finished products and components helps align inventory with sales and operations. Misclassification, such as treating finished goods as raw materials, can skew financial ratios and mislead stakeholders. Indian Accounting Standard ensures that inventory is categorized correctly, aligning with business operations to present a truthful financial picture. Applying the right cost formula is critical for TechGear. They choose FIFO for their $5 million electronics inventory, ensuring alignment with operational flow. Inconsistency in formula application can lead to significant reporting errors, confusing investors and managers. Indian Accounting Standard mandates consistent application across periods to maintain comparability. This step builds on previous classifications, setting a calculated cost for inventory transactions. TechGear must assess whether the $5 million inventory's market value justifies its recorded cost. This involves comparing against expected selling prices, less any costs to complete and sell. Ignoring market trends can lead to overstated inventory values, impacting financial decisions. Indian Accounting Standard ensures inventory is valued at the lower of cost or net realizable value, protecting against inflated asset reporting. Finally, TechGear must accurately document all inventory transactions to reflect their $5 million valuation. This includes FIFO application and NRV assessments. Omitting adjustments can lead to distorted financial statements, misleading stakeholders about financial health. Indian Accounting Standard requires thorough documentation of inventory changes to ensure transparency and accuracy in financial reporting. This final step consolidates previous efforts, ensuring TechGear's financials are both accurate and compliant. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. Indian Accounting Standard 2 governs inventory valuation, dictating specific methods and disclosures that ensure transparency. Understanding these can mean the difference between accurate reporting and financial misstatements. Indian Accounting Standard 2 requires initial inventory recognition at cost, capturing the total expense incurred to bring items to their current condition and location. This includes purchase price, import duties, and transport fees. Recognition occurs when control transfers, usually upon delivery. Trade discounts and rebates lower purchase costs, while manufacturers must add direct labor and manufacturing overheads. Once on the balance sheet, inventory must be valued at the lower of cost or net realizable value under Indian Accounting Standard 2. Net realizable value considers the estimated selling price less costs to complete and sell. This principle ensures inventory isn't overstated, protecting against obsolescence or market declines. Write-downs to NRV aren't reversible unless inventory fully recovers in value. Inventory is recorded as a current asset, reflecting its conversion to cash within a year. The cost of goods sold is presented in the profit and loss statement, impacting gross profit. Notes to financial statements disclose inventory methods and values, offering transparency. Classification relies on inventory type, raw materials, work in progress, or finished goods, each playing distinct roles in production. Indian Accounting Standard 2 mandates specific disclosures to ensure financial clarity. Companies must reveal their inventory valuation policy, aiding comparability. Disclosure of write-downs and reversals informs stakeholders about potential inventory risks. Reporting inventory recognized as an expense impacts profitability analysis. Pledged inventories need disclosure, highlighting assets tied to financial obligations, which affects liquidity assessment. How does a CFO apply Indian Accounting Standard 2 in practice? Imagine managing $50 million inventory. The CFO must ensure costs include all necessary expenses, avoiding misstatements. Constant vigilance is needed to compare cost to NRV, preventing overstatements. If $10 million inventory is pledged, it's disclosed, maintaining transparency. A $500,000 write-down affects net income, requiring clear explanation to stakeholders. Meridian Corporation, a global manufacturing company, acquires $1,200,000 in raw materials for its production line. Watch as each accounting event unfolds, from initial recognition to how these costs impact the financial statements over time. When Meridian Corporation buys raw materials, Indian Accounting Standard 2 mandates that these are initially recognized at cost. This entry boosts the inventories account by $1,200,000, reflecting the acquisition's value. Accounts payable mirrors this, indicating an obligation to suppliers. This sets the stage for future production and revenue generation. Under Indian Accounting Standard 2, direct labor costs are capitalized as part of inventory costs. Meridian Corporation records a $500,000 increase in inventories, reflecting the labor directly attributable to production. This entry reduces cash, signaling payment for workforce efforts. Capitalizing these costs ensures inventory values reflect complete production costs. Indian Accounting Standard 2 requires that all costs directly attributable to bringing inventory to a saleable condition be included. Thus, Meridian Corporation allocates $300,000 in overhead to inventories. This reflects costs like utilities and maintenance, ensuring the inventories represent the full cost of production. This comprehensive cost captures the true value of production efforts. As production concludes, Indian Accounting Standard 2 guides the transition from work in progress to finished goods. Meridian Corporation records this $2 million shift, marking the completion of production. Finished goods now reflect the total cost, poised for sale, while work in progress decreases accordingly. This reclassification is critical in inventory accounting. Selling inventory triggers two vital entries. $1,500,000 is expensed as cost of goods sold, reducing finished goods. This aligns with Indian Accounting Standard 2's directive to recognize cost when revenue is realized. Simultaneously, $2,500,000 is recorded as revenue against accounts receivable, revealing sales success and boosting the income statement. Indian Accounting Standard 2 instructs inventories to be valued at the lower of cost and net realizable value. Meridian Corporation adjusts $500,000 worth, reflecting market conditions. Cost of goods sold is debited, aligning financials with reality. This safeguards against overstatement, providing a faithful representation of inventory worth on the balance sheet. Writing off obsolete inventory is a key requirement under Indian Accounting Standard 2, ensuring inventory is not overstated. Meridian Corporation writes off $100,000, impacting the income statement by increasing cost of goods sold. This ensures inventory values reflect only what can be realistically converted to revenue, maintaining accurate financial reporting. Indian Accounting Standard 2 requires adjustments for inventory discrepancies like shrinkage. Meridian Corporation records a $50,000 adjustment, reflecting discrepancies between book and physical counts. This hits cost of goods sold, aligning with the reality of inventory control. Accurate adjustments are essential for truthful financial reporting, supporting decision-making and investor confidence. Every Big Four and investment bank interview on Indian Accounting Standard 2 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. Inventory under Indian Accounting Standard 2 includes assets held for sale in the production process or materials consumed in production. This definition helps in correct asset categorization. A common mistake is confusing inventory with fixed assets, which affects balance sheet classification. Always remember, inventory is intended for sale within the normal business cycle. Indian Accounting Standard 2 exists to prescribe the accounting treatment for inventories. providing guidance on determining cost and subsequent recognition as an expense. This ensures accurate financial reporting. Confusion often arises when estimating net realizable value. The key takeaway: inventory valuation impacts gross profit and overall financial health. When net realizable value is less than cost, inventory must be written down to net realizable value. This reflects potential losses. Misapplication occurs when companies delay write-downs to manipulate earnings. Remember, timely recognition of losses maintains accurate financial statements and investor trust. Indian Accounting Standard 2 prohibits LIFO, similar to international financial reporting standards, but emphasizes FIFO and weighted average. LIFO is a common error during conversion, leading to incorrect valuations. This affects COGS and inventory valuation. Always check compliance with the appropriate standards when analyzing international companies. Inventory must be recorded at cost, not selling price, ensuring accurate profit measurement. The trap: equating cost with potential revenue leads to inflated asset values. Remember, cost includes purchase, conversion, and necessary expenses, excluding selling price. Avoid this mistake to maintain reliable financial statements. Inventory write-downs reduce asset values on the balance sheet and increase COGS, thus lowering net income. Misunderstanding this can lead to overstated profits. Recognize the dual impact on financial health, affecting both the income statement and balance sheet. It's essential for accurate financial analysis. Under FIFO, the oldest costs are assigned to COGS. For example, if starting inventory is 100 units at $10 each, and purchase is 50 units at $15, COGS for 120 units sold would be $1,150. Errors occur if recent costs are mistakenly used. Understanding FIFO ensures accurate cost assignments. Indian Accounting Standard 2 excludes work in progress under construction contracts, financial instruments, and biological assets. Misclassification here results in inaccurate accounting. Understanding exclusions prevents erroneous inventory classification. Key lesson: precision in categorizing inventory ensures true financial representation and compliance with accounting standards. Indian Accounting Standard 2 requires disclosure of accounting policies, inventory carrying amounts, and write-downs in financial statements. Missteps occur when disclosures are incomplete, hindering transparency. Disclosures provide insight into inventory valuation methods, essential for investors. Remember, clear and complete disclosures maintain stakeholder trust and compliance. Misapplying cost formulas leads to incorrect inventory valuation, impacting COGS and profitability. For instance, using LIFO instead of FIFO under Indian Accounting Standard 2 is a frequent error. Avoid this by adhering strictly to standards and verifying the cost flow assumptions. Accurate formula application is crucial for financial integrity. Indian Accounting Standard 2 focuses on proper valuation and recording of inventories. It excludes items like financial instruments and construction contracts. Inventories are assets held for sale, production, or materials. They're measured at the lower of cost or net realizable value. Cost includes purchase, conversion, and other necessary expenses. Understanding these basics ensures accurate inventory reporting. Indian Accounting Standard 2 allows FIFO or weighted average cost for inventory measurement. Specific identification applies to unique items. Costs include purchase price, duties, and transport, excluding abnormal waste. Always compare inventory cost to net realizable value. Trade discounts reduce costs directly, and borrowing costs are considered if Indian Accounting Standard 23 applies. Mastering these rules ensures accurate inventory valuation. For interviews, remember NRV adjustments are crucial, not optional. Indian Accounting Standard 2 mirrors IAS 2 but is tailored for India. Disclosures must include inventory methods and values. Avoid errors like including abnormal waste in cost. Consistency in FIFO or weighted average is critical. Unlike U.S. generally accepted accounting principles, Indian Accounting Standard allows write-down reversals if NRV rises. Accurate documentation enhances inventory management. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos.